Welcome, deep divers, to what I think is a truly captivating story of corporate reinvention. Today, we're not just looking at a company, we're witnessing something like a phoenix, you know, rising, shedding its past, and dramatically reshaping its whole identity.
It really is something else.
Yeah, I mean, imagine a business that was once this sprawling global education giant navigating nearly 30 different countries, weighed down by just colossal debt,
Mm.
then decides to hit a giant reset button, sells off billions in assets, and emerges as something entirely different. That's the extraordinary journey we're charting today.
And it's an incredible narrative, absolutely. And it goes far beyond just a typical corporate restructuring. This is about a company making a really bold, almost existential decision to completely overhaul its strategy, not just to survive, but to truly thrive in a new, much more focused form.
Precisely. Our deep dive today is into Laureate Education, Inc., or LAUR, if you follow it on the NASDAQ.
Mhm.
And this isn't merely a business case study. It's a fascinating look at the intricate dance between education, high finance, and, well, the ever-shifting geopolitical currents.
Yeah, especially within Latin America.
Exactly, particularly within the vibrant, yet, let's be honest, sometimes volatile landscape of Latin America.
So our mission today really is to genuinely unpack this whole complex saga for you. We're going to dissect Laureate's strategic metamorphosis, assess its current highly focused position, delve into its remarkably transformed financial health, which, spoiler alert, is a dramatic turnaround,
It really is.
and pinpoint the critical factors, the things that are expected to drive its performance in the years to come.
So settle in. We're going beyond just what changed. We're going to explore why it changed, the profound implications of those shifts, and what it all means for the future of education and, well, investment too. It's a compelling tale of strategic clarity, unwavering resilience, and laser-like focus that transformed an empire into an efficient, potent force.
Right. So to truly appreciate where Laureate is today, we really have to understand where it was, don't we?
Definitely.
Cast your mind back to before 2020. This wasn't just a large company. It was a true global behemoth, almost unimaginable in its scale and reach. Can you maybe paint a picture of this as a global conglomerate?
Yeah, the before picture of Laureate is, frankly, almost of an entirely different species of company. At its zenith, its peak, around, say, 2017, it was this truly vast, sprawling global network. It boasted an astounding portfolio of over 75 post-secondary institutions.
75. Wow.
Yeah, imagine that, spread across nearly 30 countries around the world. We're talking about an educational empire that, at its peak, served over 1 million students globally under its massive umbrella. 1 million students.
It was, by any measure, an educational colossus, a real force to be reckoned with on a global scale.
1 million students across nearly 30 countries. That's just an absolutely astounding number. But I can only imagine the sheer complexity, right? The logistical nightmares and just the inherent challenges that must have come with managing something of that magnitude, especially when you factor in so many different regulatory environments, cultural nuances, currency fluctuations.
No, completely.
That sounds less like a cohesive business and more like, I don't know, 30 separate ventures trying to row and sink.
You basically hit the nail on the head there. That kind of global scale, while it looks impressive on paper, it came with significant operational and financial baggage. The chief challenge, like a heavy anchor, was a substantial debt load.
Right.
And running an operation that expansive with such geographical diversity, it naturally introduces immense complexity and a multitude of inherent risks, everything from varying political climates and regulatory shifts to diverse local market demands and, yes, those ever-present currency fluctuations. It was a company that was, by many accounts, spread incredibly thin, really struggling to optimize and find synergy across so many disparate geographies.
Yeah.
It's kind of a classic case where diversification might have actually been diluting focus and value.
And so, faced with these challenges, 2020 marks this pivotal moment. The company embarks on what can only be described as a radical transformation, not just some minor adjustment. What was the catalyst for this bold strategic pivot? How did it originate?
It was indeed a very bold, deliberate, and some might even say audacious decision. The genesis of this profound transformation was a comprehensive strategic review, formally kicked off back in January 2020. The explicit overriding goal was unambiguous: unlock shareholder value. Management had really come to the sober recognition that the unwieldy, complex, and geographically dispersed global structure was, in fact, obscuring the true potential and value of its underlying core assets. They realized they were worth more in parts, or maybe at least in fewer, more focused parts.
And what followed was this systematic divestiture program, correct? I mean, they weren't just selling off a few underperforming campuses here and there. They were carving off entire national operations, huge chunks of the business. This wasn't just nibbling around the edges.
Precisely. No, what unfolded was an incredibly systematic and quite aggressive program of asset sales. They divested operations in key regions globally, places like Australia, New Zealand, Brazil, Chile, Malaysia, and many other markets where they once had a significant footprint.
Mm-hmm.
This extensive asset sale program was executed with remarkable speed, actually, and generated over $5 billion in proceeds.
$5 billion.
Yeah. And the strategic rationale behind this wasn't just about shrinking. It was multifaceted. It allowed them to crystallize value from assets that were perhaps undervalued or overlooked within that larger, more complex global structure. Critically, it enabled them to significantly pay down that crippling debt load we mentioned.
Right, that anchor.
Moving from a position of financial vulnerability to one of immense strength. And perhaps most importantly, it allowed them to strategically redeploy both that capital and, crucially, management's attention and focus. It was far more than simple downsizing. It was a profound reconcentration, a strategic reset that really defined their future.
Okay, so if that's the before and the pivot, let's talk about the after picture. What does the new Laureate look like? Where do they stand now after this incredible reshaping?
The after picture is of a dramatically different, almost unrecognizable company, really. We're now looking at a streamlined, financially robust enterprise with just a razor-sharp, intentional focus. Laureate has fundamentally repositioned itself from that global conglomerate to a regional leader, concentrated in two specific high-growth, higher education sectors, Mexico and Peru.
Just those two.
Just those two. And this strategic choice was a very deliberate trade-off, consciously shedding global diversification in favor of achieving deep regional market leadership and unlocking enhanced financial flexibility. It's kind of like going from trying to run 30 different restaurants to just perfecting 2 flagship locations,
Yeah, that's a good analogy. And what are the tangible, measurable outcomes of this transformation? How has this shift really profoundly impacted their market position and, just as importantly, their financial health?
Well, the outcomes have been nothing short of profound. Laureate now boasts clear market leadership within these carefully chosen geographies. Financially, the difference is literally night and day. They've transitioned from being heavily indebted to having a pristine balance sheet, now sitting in a remarkable net cash position.
Net cash. Incredible.
Yeah. Their strategic playbook is now dual-pronged. A clear, aggressive pursuit of organic growth within these core markets, coupled with an equally strong commitment to significant capital returns to shareholders. And, to really illustrate the scale of this shift, just consider their student body. From over 1 million global students at its peak, they now serve a more focused but growing base of approximately 472,000 students as of mid-2025.
Still a huge number, but much more focused.
Exactly.
Yeah.
It reflects that deliberate trade-off, a conscious decision to forego global reach for unparalleled regional depth and robust financial health. It's a really compelling narrative of strategic focus delivering tangible results.
That's a remarkable shift indeed. So, having shed the global empire, Laureate is now deeply, almost exclusively rooted in Mexico and Peru. What does that operational footprint actually look like on the ground? What specific brands are they operating, and, how large is their presence in each of these countries?
Okay, so in Mexico, Laureate operates 2 of the largest and most recognized private university systems in the entire country. First, there's Universidad del Valle de Mexico, widely known as UVM.
Okay, UVM.
And second, Universidad Tecnológica de Mexico, or UNITEC.
UNITEC, got it.
These aren't just names. They are absolute titans in the Mexican private education sector. By the end of 2024, they collectively enrolled an impressive figure of over 258,500 students across more than 30 strategically located campuses throughout the country.
Wow. Over 250,000 in Mexico alone.
Yeah, and UVM in particular is frequently cited as the single largest private university in Mexico. It offers an incredibly wide range of programs, everything from high school and undergraduate degrees all the way up to master's and doctoral programs, really catering to a diverse student body.
So they're clearly a dominant force, practically a household name in Mexico. What about their presence in Peru? Is it similarly scaled?
In Peru, Laureate's portfolio is equally robust and strategically positioned. It includes Universidad Peruana de Ciencias Aplicadas, or UPC, Universidad Privada del Norte, UPN, and the Cibertech Technical Institute, which specializes more in career-focused vocational training.
Okay.
Combined, these institutions enrolled over 213,500 students across more than 19 campuses by the end of 2024.
Another 200,000 plus.
Exactly. And, strikingly, UPN has carved out a significant position as the second largest private university in the entire country. So that demonstrates their strong competitive standing and brand recognition, even in what can be a challenging market like Peru.
So it's clear they have immense scale in both these markets, but I want to dig a bit deeper into why that scale matters so much in the education sector. Like, what specific durable competitive advantages does this extensive footprint provide them beyond just being big?
Right, and this is a really crucial insight. Laureate isn't just big for the sake of being big. It's strategically big. This extensive footprint fosters incredibly strong brand equity, which is absolutely vital in attracting and retaining students in competitive markets where trust and reputation are just paramount. It's kind of like a multi-layered moat, you know?
Yeah.
Imagine a startup trying to replicate this. They would need to establish decades of trust, build dozens of modern campuses, navigate incredibly complex regulations in two distinct countries.
Yeah.
It's a huge undertaking.
Almost impossible.
Right. Laureate, on the other hand, operates at an economic scale that funds cutting-edge curriculum development, invests in advanced technology platforms, something smaller institutions just can't afford, and it drives significant operational leverage in functions like marketing, procurement, and administrative support. These efficiencies are very, very difficult, if not impossible, for smaller local competitors to replicate. It effectively makes Laureate almost unassailable from direct competition within these specific high-growth niches they've chosen.
Right.
Their scale isn't just about market share. It's really about competitive insulation.
That makes a lot of sense, especially in a sector where brand and resources truly matter. Let's talk about the economics then. Where does the revenue actually come from for Laureate, and what kind of academic programs do they prioritize? Are they just offering general degrees, or is there a specific focus?
Laureate's revenue model is refreshingly straightforward, actually. It's almost entirely derived from student tuition and fees.
Okay, tuition?
Yeah. This direct-to-consumer model means their success is directly tied to student enrollment and retention. Looking at their 2024 revenues, the split was remarkably balanced between their two core segments. Mexico contributed about $841.2 million, which is 54% of total revenues.
Okay.
And Peru contributed $725.2 million, making up the remaining 46%.
Pretty balanced.
Very balanced. This diversification within their focused geographic footprint provides a really robust base, ensuring that they're not overly reliant on one single market for their financial health.
And regarding the academic programs, is there a particular niche they're filling, or is it a broad offering?
The academic portfolio is intentionally comprehensive, but critically, it's aligned with the real-world demands of the labor market. They focus heavily on career-oriented fields, fields that are experiencing high demand and offer clear pathways to employment. We're talking about programs in health sciences, business and management, engineering, information technology, law, and design. This employability-centric approach is really a core part of their value proposition to students.
Makes sense.
It's about providing an education that directly leads to a better career, higher wages, and ultimately upward social mobility, rather than just, abstract knowledge.
Yeah.
They're essentially selling a return on investment, not just a degree.
Right, right. In a world that's increasingly digital, education is no exception. Laureate has made significant investments in a hybrid delivery strategy. How does this modern approach to learning actually work, and what tangible benefits does it bring, both for students and, well, for the company?
Yeah, this hybrid delivery model is a critical pillar of their modern operating framework and really a testament to their adaptability. Laureate has invested substantially in scalable technology platforms and in extensive ongoing faculty training for digital content development and online delivery. This wasn't just some strategic option. This capability was seriously stress-tested and proven under extreme conditions during the COVID-19 pandemic.
Right, everyone had to pivot fast then.
Exactly. And they were able to swiftly transition their entire student body to remote learning, demonstrating remarkable agility and resilience. That experience really cemented digital learning as a core, indispensable competency for the entire organization.
And what's the strategic objective behind this widespread adoption of online delivery? Is it simply about flexibility, or is there kind of a bigger play here?
Oh, it's definitely a bigger play.
Yeah.
The company has a clearly stated goal of having between 40% and 60% of all student credit hours delivered online.
40 to 60%, okay.
Yeah. This strategy serves a dual purpose, effectively expanding their addressable market. For traditional campus-based students, they offer blended learning models, where maybe 20% to 60% of their coursework is online. That provides greater flexibility and convenience in their learning journey.
Sure.
Then, to specifically capture the vast and growing market of working adult people looking to advance their careers but need maximum flexibility, they offer fully online programs, with 80% to 100% of the coursework delivered remotely. This is crucial for reaching a demographic that traditional brick-and-mortar institutions often struggle to serve effectively.
That sounds incredibly efficient and certainly very appealing to a broader student base. Does this hybrid and online model also translate into significant financial benefits for Laureate?
Absolutely, it does. This strategic push into digital and hybrid learning isn't just about meeting student preferences or expanding market reach. It's a key driver of financial efficiency and margin expansion. Well, online and hybrid programs generally have lower capital intensity. That means less need for extensive physical infrastructure and real estate per student, which translates into lower capital expenditures.
Right. Fewer buildings needed.
Exactly. They can also scale much more efficiently than traditional brick-and-mortar campuses, allowing Laureate to enroll more students without proportional increases in fixed costs. This operational leverage is a significant contributor to the company's goal of expanding its adjusted EBITDA margins. And, to truly showcase their technological innovation, they've even deployed an AI-powered virtual student assistant across their network,
Oh, interesting.
which impressively handled over 1 million student queries in just its first 6 months alone. That further enhances efficiency and student support.
Wow. So ultimately, the heartbeat of an education business is its students. What do the student demographics and enrollment dynamics look like? And beyond the numbers, what does it tell us about the broader social impact of Laureate's work in these regions?
Yeah, enrollment is, without a doubt, the primary driver of Laureate's revenue and their most critical non-financial key performance indicator, or KPI. The company ended 2024 with approximately 472,000 students and reported a very similar figure, 472,100, as of June 30, 2025. These numbers demonstrate really robust underlying demand. Total enrollments grew 6%, and new enrollments grew 7% year over year in the first half of 2025.
Strong growth.
Yeah, this isn't just incremental growth. It's a strong indication of the value proposition really resonating with students. Management's guidance for full year 2025 projects continued expansion, with total student numbers expected to reach a range of 491,000 to 495,000. That illustrates consistent, healthy growth post-transformation.
Beyond just these impressive numbers, there seems to be a really compelling social impact at play here too, isn't there? I mean, who are these students really?
This is where Laureate's public benefit mission, we'll talk more about that later, truly shines. Approximately 47% of Laureate's students are the first in their families to attend university.
Nearly half. Wow.
Yeah. Think about the profound implications of that statistic. This directly connects the company to the burgeoning middle class in Latin America and underscores the incredibly powerful aspiration for social mobility that quality higher education provides.
Absolutely.
For these students, a university degree isn't just a piece of paper. It's a gateway to a fundamentally better life, a breaking of intergenerational cycles, and a fulfillment of deep-seated family aspirations. It highlights that Laureate isn't just a business extracting tuition. It's a critical pathway to upward mobility and societal progress for hundreds of thousands of individuals. And, when you examine the enrollment table in their reports, you can vividly trace those post-transformation growth trends taking firm hold, showcasing not just business success, but real social impact.
Okay, so Laureate has strategically chosen Mexico and Peru as its core battlegrounds. Let's really dig into the industry dynamics of these markets, starting with Mexico. What makes this such a compelling, perhaps even unique, growth landscape for higher education?
Mexico truly presents just a compelling growth opportunity. It's almost a demographic goldmine for education, you could say. Market research projects that the sector will expand at a compound annual growth rate, a CAGR of 9.3% from 2024 to 2030.
9% CAGR, that's huge.
It is, with the total market revenue forecast to reach an impressive $26.6 billion. These are powerful secular trends driven primarily by a uniquely youthful workforce. Mexico boasts the youngest in North America, with a median age of just 29.6 years.
Very young population.
Yeah, this demographic reality ensures a sustained, robust pipeline of prospective students for decades to come. Higher education enrollment is already rapidly expanding, reaching 5.2 million students in the 2023-2024 academic year. And crucially, there's strong vocal demand from employers for graduates equipped with practical career-oriented skills. It's kind of a virtuous cycle. Young population, increasing enrollment, and strong employer pull.
That's a significant growth trajectory. But in such a large and growing market, Laureate certainly isn't operating in a vacuum. Who are their main competitors in this dynamic landscape, and how do they position themselves against them?
Right. The competitive landscape in Mexico is quite nuanced. It really operates on two distinct layers. On the public side, you have these venerable institutions like the National Autonomous University of Mexico, UNAM,
Oh, UNAM.
which is not only the nation's largest, but also its most prestigious university. Critically, public universities in Mexico are often tuition-free or heavily subsidized.
Free is hard to compete with.
Exactly. It creates a significant structural challenge and a permanent price ceiling for private providers. Then, on the private sector front, Tecnológico de Monterrey, or ISM, is another leading academic and entrepreneurial hub with a strong international reputation.
Yeah.
They tend to cater to a more affluent segment. Laureate's UVM and Unitech brands are strategically positioned to thrive kind of in the middle, offering large-scale, quality private alternatives that provide a strong value proposition. They focus heavily on affordability, accessibility, and clear employability outcomes, thereby catering to a broad and aspirational segment of the population that seeks quality but might not have access to, or maybe can't afford, the most elite private options.
Makes sense, finding that sweet spot. And what's the regulatory environment like in Mexico? Does it generally favor or hinder the growth and operation of private educational institutions?
Well, the regulatory environment involves a competitive admission process for most universities, which ensures a baseline of quality. However, that structural reality of tuition-free public universities consistently creates a significant, almost permanent price ceiling for private institutions.
Right, that pressure is always there.
Always. This means private providers like Laureate must continually differentiate themselves through superior academic quality, innovative program flexibility like their hybrid models, and, most importantly, clear, demonstrable career outcomes to justify their tuition fees. It's not enough to just be good. They have to be perceivably better in terms of value and career advancement.
Got it. Okay, let's shift our focus now to Peru, where the market has a slightly different, maybe even more dramatic story you mentioned, a flight to quality. What were the primary growth drivers there, and how did the competitive landscape get fundamentally reshaped in such a decisive way?
Yeah, Peru's higher education market underwent nothing short of a dramatic transformation. It's truly a case study in market rationalization. Between, say, 2008 and 2018, it experienced rapid enrollment growth, even faster than any other country in Latin America at the time.
Faster than anywhere else.
Wow. Yeah, largely fueled by robust economic expansion and a burgeoning middle class. The private sector quickly became dominant, accounting for a remarkable 76% of the overall market. Now, it's important to acknowledge that Peru has seen some recent political and economic volatility for sure. However, the underlying demand for quality education remains incredibly strong and remarkably resilient, largely due to the significant wage premium that university graduates consistently earn. It makes education a clear investment in future income for families.
So where does this concept of a flight to quality come into play? How did the market evolve to that point?
Okay, this is where it gets really interesting and provides a powerful insight into Laureate's positioning. Prior to 2014, there was this largely unregulated proliferation of low-quality, often frankly fly-by-night for-profit institutions.
Ah, okay. A bit of a Wild West.
Exactly. This created significant quality control issues, eroding public trust and devaluing degrees. In response, the Peruvian government initiated sweeping reforms, leading to the closure of over 50 underperforming universities.
50 universities closed.
Over 50. Imagine being a student in Peru during that period, the uncertainty of choosing a university, hoping it wouldn't be one of the ones shut down. This drastic action fundamentally reshaped the market, consolidating it around a smaller number of accredited higher-quality institutions. And this forced flight to quality directly and profoundly benefited Laureate's well-regarded UPC and UPN brands, as students, quite rationally, gravitated towards reputable, stable providers who could guarantee a quality education.
Makes sense.
Remaining competitors include other highly ranked institutions like Pontificia Universidad Católica del Perú, or PUCP, but the playing field was drastically altered in favor of established, quality players like Laureate.
And it sounds like the regulatory environment in Peru didn't just play a role, it was almost the architect of this market reshaping. Can you elaborate on that? Like, what specifically happened?
Yeah, this brings us to a crucial point about regulatory impact. The most significant feature, the real game changer, was the 2014 University Act. This act created the Superintendencia Nacional de Educación Superior Universitaria, known commonly as HUNEDU.
Sonadu.
Okay, SUNEDU was empowered to implement incredibly stringent licensing requirements, covering everything from the quality of campus infrastructure and faculty qualifications to research capabilities and, critically, financial viability.
So really comprehensive oversight.
Very comprehensive. This rigorous regulatory regime now acts as a formidable, almost insurmountable barrier to entry for new players. And equally important, it functions as a powerful, government-enforced competitive advantage for established incumbents like Laureate, who have successfully met these exceptionally high standards. This government-enforced quality control has truly rationalized the competitive landscape, weeding out the weaker players and solidifying the position of those committed to quality education. It's a classic example of regulation creating a kind of competitive moat.
Fascinating. So looking at both Mexico and Peru, what are the overarching industry tailwinds, those powerful underlying forces that continue to give Laureate strong momentum for growth in the coming years?
Well, there are several powerful tailwinds consistently at play, fueling Laureate's growth prospects. First, as we touched on, remarkably favorable demographics. Both Mexico and Peru possess youthful populations, ensuring a sustained, robust pipeline of prospective students for decades.
The demographic dividend?
Exactly. Second, there's that incredibly strong drive for socioeconomic mobility and aspiration. A university degree is universally seen as the most potent pathway to the middle class and to securing higher wages. That drives resilient and deeply ingrained demand for higher education. Third, the accelerating trend of digital adoption and market expansion. Online and hybrid models aren't just a convenience, they're fundamentally expanding the addressable market, especially for working adults who seek flexible learning options that fit into their busy lives.
Right, reaching new student segments.
Precisely.
Yeah.
And finally, that ongoing flight to quality we discussed, particularly amplified by regulation. In increasingly competitive job markets, established, accredited brands are benefiting immensely as students and employers alike prioritize verifiable quality.
Okay, so those are the forces pushing them forward. What about the headwinds? What are the most significant challenges Laureate faces in this otherwise dynamic and promising environment?
Right. Despite those powerful tailwinds, there are definitely significant structural challenges. Affordability and economic cycles are a major headwind. Demand for private education is inherently sensitive to the economic health of the region.
Sure.
A recession or a prolonged period of high inflation in Mexico or Peru could significantly reduce household disposable income, making private university tuition less affordable and impacting enrollment and pricing power. Then there's the perennial formidable competition from the public sector, which, as we discussed, acts as that permanent price ceiling.
Always looming.
Always looming, requiring constant justification of tuition fees through superior value. We also have to consider the long-term risk of technological disruption. Things like alternative credentials, micro-degrees, boot camps, purely online platforms that could challenge the traditional degree model and student preferences down the line.
That's a big unknown.
It is. And finally, perhaps the most immediate and constant structural headwind is regional political instability, which can flare up unexpectedly, and the significant direct impact of Mexican peso and Peruvian sol devaluation on U.S. dollar-reported financial results. Foreign exchange volatility is just a constant factor that management has to navigate day in, day out.
That's a really comprehensive look at the industry dynamics. Okay, let's pivot now to Laureate's financials, which, as we've said, have undergone such a dramatic transformation. When we talk about revenue growth, it's crucial to strip out some of the noise, particularly with that foreign exchange volatility, isn't it?
You're absolutely right. This is where the numbers can be a bit deceptive if you don't peel back the layers. To get a true picture of Laureate's underlying operational performance, it's absolutely crucial to focus on organic, constant currency metrics.
Okay, constant currency.
Yeah, this approach effectively strips out the significant volatility introduced by foreign exchange fluctuations, which, as we just discussed, is a persistent headwind in these markets. So for the full year 2024, The company reported revenue of $1.567 billion.
Okay.
That was a healthy 6% increase on a reported basis.
Hmm.
But more indicative of underlying performance, revenue on an organic constant currency basis actually grew by an even stronger 7%. And that was driven by a very healthy 5% increase in total student enrollments.
So solid underlying growth. And how did that trend continue or perhaps shift into the first half of 2025? It sounds like there were some calendar quirks in there as well.
Indeed, yeah. The first half of 2025 initially showed some headline challenges. Reported revenue actually decreased by 2% to $760.3 million.
A decrease. Okay.
But this reported decline, however, was primarily due to two factors: unfavorable foreign currency translation, and as you noted, an academic calendar shift that pushed approximately $18 million of revenue from the first half into the second half of the year.
A timing issue.
Exactly. It's a classic example of why we need to deep dive past the headlines. When you adjust for these non-operational factors, the underlying organic constant currency revenue actually grew a robust 6%. And if you further adjust for just that calendar timing shift, the underlying growth was an even stronger 9%.
9% adjusted. That's strong.
Very strong. It demonstrates incredibly strong underlying operational momentum despite what that initial reported decline might suggest.
So management's guidance for the full year 2025 must reflect that underlying strength and maybe more favorable trends they're seeing then?
It certainly does. Reflecting this strong performance and critically more favorable currency rates than initially expected earlier in the year, management has actually raised its full year 2025 revenue guidance.
Oh, they raised guidance. Good sign.
Yeah, to a range of $1.615 billion to $1.630 billion. This revised forecast implies reported growth of 3-4% and organic constant currency growth of 6-7% for the full year. That indicates continued robust momentum and confidence in their operational execution and their core markets.
Okay. Beyond just revenue, how does this growth translate into actual profitability and margin expansion? Are they becoming more efficient at converting those tuition dollars into profit?
Absolutely. Laureate has demonstrated a very strong ability to translate that revenue growth into significantly higher profits, aided by operating leverage and ongoing efficiency initiatives resulting from their focused strategy. For the full year 2024, operating income grew a solid 10% to $374.0 million.
10% operating income growth.
Yeah. And adjusted EBITDA, which is a key metric management uses to evaluate core operating performance, increased a very healthy 8% to $450.1 million. Now, it's important to note, net income attributable to Laureate surged an exceptional 176% to $296.4 million.
176%. That's massive.
It is massive. But this outsized growth in reported net income, while impressive, was significantly influenced by non-operating items, particularly a large gain on foreign currency exchange related to intercompany balances, as well as a discrete tax benefit.
Okay, some one-offs in there.
Exactly. This really underscores why adjusted EBITDA is often a more reliable gauge of the true health of the core business, as net income can be subject to high volatility from these non-cash, non-operational factors that don't really reflect the underlying business strength day to day.
Got it. So even accounting for those non-operating influences, the core business's profitability looks robust. What about the first half of 2025 in terms of adjusted EBITDA?
Okay, so for the first half of 2025, adjusted EBITDA was $219.8 million. Now, that appeared roughly flat compared to the prior year on a reported basis. However, this result absorbed a negative impact of approximately $16 million from that academic calendar shift we mentioned earlier.
Right, the timing adjustment again.
Exactly. So when you accurately adjust to this timing effect, the underlying adjusted EBITDA growth was actually a very strong 17% versus the prior year period.
17% adjusted growth. Nice.
Yeah. This is the real story of their operational efficiency and growth shining through the accounting noise.
And what's the outlook for their margins for the full year? Are they anticipating continued efficiency gains?
Indeed. Management has, once again, raised its full year 2025 adjusted EBITDA guidance to a range of $489 million to $496 million.
Raised EBITDA guidance too.
Yeah. This updated forecast implies impressive reported growth of 9-10% and organic constant currency growth of 11-13%. That signals clear expectations for significant margin expansion during the year. Specifically, they're targeting approximately 150 basis points of margin expansion in fiscal 2025.
Wow.
Which would be a notable achievement and speaks volumes about their operational focus and ability to drive efficiencies.
Now, perhaps the most dramatic outcome of this entire transformation, the balance sheet strength. Moving from being deeply debt-laden to actually having a net cash position that's quite a swing, a literal financial phoenix story, isn't it?
This is truly the crowning achievement of Laureate's transformation, the most significant and dramatic outcome, I'd say. The company has successfully moved from being a highly leveraged entity, burdened by significant debt service obligations, to one with an incredibly strong, almost pristine balance sheet, and remarkably, a net cash position.
So what are the numbers?
As of June 30, 2025, Laureate held $135.3 million in cash and cash equivalents against only $116.1 million in gross debt. This results in an impressive net cash position of $19.2 million.
Net cash of almost $20 million. That's a stark contrast to their previous state and really highlights the success of their divestiture strategy.
Absolutely. I mean, to put in perspective, even at the end of fiscal 2024, their total debt obligations were still a very manageable $102.2 million, having already paid down so much. This conservative capital structure provides immense financial flexibility. They're just no longer constrained by debt service obligations.
Frees up cash flow.
Exactly. It frees up substantial capital to be deployed towards growth initiatives and, crucially, returning value directly to shareholders. It's a complete reversal of fortune, financially speaking.
And how cash generative is this business model in general? Does it consistently churn out free cash flow?
Yeah, the business model, particularly post-transformation, is inherently highly cash generative and what management frequently refers to as cash accretive. For the full year 2024, cash flow from operations totaled a robust $232.7 million.
Strong operating cash flow.
Very strong. And the trailing 12-month free cash flow as of June 2025 stood at an impressive $228 million. This strong, consistent, and predictable cash flow is not merely a side effect. It's a cornerstone of the company's new, robust financial profile and directly enables its aggressive capital allocation policies.
So with all that cash being generated in a net cash position, what exactly is their capital allocation strategy? How do they decide where to put their money? Is it all about growth, or are shareholders seeing the benefits too?
Well, their capital allocation strategy is a direct and very beneficial consequence of their successful business transformation. It's built upon two primary, clear pillars. First, investing prudently and strategically in organic growth to expand their reach and capabilities.
Nice.
And second, returning excess capital to shareholders. And on the shareholder returns front, they've been quite aggressive, actually, demonstrating a strong commitment. In February 2024, the board authorized a new $100 million stock repurchase program.
Oh, a buyback.
Yeah, and they've been actively executing this. $42 million was repurchased in the first quarter of 2025, reaching $71 million by the end of the second quarter. So this isn't just a paper authorization, it's active execution, demonstrating their commitment to enhancing shareholder value through buybacks.
Good to see them following through. And what about dividends? Is that a component of their shareholder return strategy?
Well, Laureate does not currently anticipate paying a regular quarterly dividend. However, they have clearly shown a willingness to use special dividends to return significant capital. For instance, back in November 2023, they paid a special cash dividend of $0.70 per share, totaling about $110.2 million.
A hefty special dividend?
It was. The company has indicated they may consider extraordinary dividends again in the future, subject to market conditions and their cash flow, as part of their overall capital allocation strategy. So it gives them flexibility.
Okay. And on the growth investment side, what are the key areas they're focusing their capital expenditures on? Where are they seeing the biggest opportunities to expand?
Right. The other core component of their strategy is intelligently reinvesting in the business to fuel future growth. The most significant investments are in strategic capacity expansion, specifically the construction of new campuses in both Mexico and Peru. These are essential to accommodate their rising student enrollment and market demand.
Building more campuses.
Exactly. They currently have 2 new campuses on track for launch in September 2025, one in Mexico and one in Peru, and 2 more are already underway for late 2026 or early 2027. Capital expenditures, CapEx, saw a significant 27% increase in 2024, precisely driven by these strategic land purchases and new campus construction.
Investing heavily.
Yeah. They also continue to invest heavily in technology to support and expand their digital and hybrid learning platforms, ensuring their competitive edge in modern education delivery. Overall, CapEx runs at roughly 25% of their operating cash flow, indicating a pretty healthy reinvestment rate.
And with a net cash position, their debt management focus must have shifted significantly. What's the strategy there now?
Yeah, with a remarkable achievement of a net cash position, the focus of capital management has fundamentally shifted from active debt reduction, because there's barely any debt left, to simply maintaining a strong and flexible balance sheet. They still have access to a $300 million revolving credit facility, which provides ample liquidity and a robust safety net to support any unforeseen strategic priorities or market fluctuations.
So they have flexibility.
Exactly. This conservative and highly flexible approach to leverage minimizes financial risk, and perhaps most importantly, it ensures that operating cash flow can be deployed primarily toward compelling growth opportunities and robust shareholder returns, rather than being continuously funneled into servicing burdensome debt like in the past.
We've covered the dramatic transformation and the solid financials. Now let's talk about the architects of this change. Who makes up the leadership team, and how have they managed to execute such an incredibly complex strategy, essentially dismantling and then rebuilding the company? It's quite a feat.
It really is. Laureate is led by a very seasoned executive team with President and CEO Eilif Sirk-Hansen at the helm. He's actually been with the company since 2008 and in the CEO role since January 2018, so he's seen a lot of this transformation firsthand.
Okay, long tenure.
Yeah. This team is widely credited, and I think deservedly so, with successfully navigating that incredibly intricate strategic review process we talked about, orchestrating the execution of over $5 billion in complex asset sales, meticulously deleveraging the company, and even rapidly responding and adapting to the unprecedented challenges of the COVID-19 pandemic.
Right.
That's a huge undertaking, demanding immense strategic foresight and, frankly, operational discipline.
That's an impressive track record, no doubt. What about the broader leadership structure? Does it have the depth to manage their now very focused operations effectively?
Yeah, the broader leadership structure seems designed for focused execution. It includes executives with deep, on-the-ground operational experience in their respective regions. They have dedicated CEOs specifically for the Mexico and Peru segments.
Local leadership?
Exactly. This ensures a strong local focus, a nuanced understanding of market dynamics, and agile decision-making, all of which are absolutely crucial for success in those specific dynamic markets. They also have a pretty credible track record of consistently meeting or even raising financial guidance in recent quarters, which speaks volumes about their execution capabilities and their ability to accurately forecast and deliver on their strategic objectives.
Now, here's where it gets truly unique and I think very thought-provoking from a governance perspective. Laureate operates with a unique status as a public benefit corporation, or PBC. What does that actually mean in practice, and how might that status impact investors, especially when we've just discussed their aggressive focus on financial returns? It seems like a potential tension.
It does. And this brings up a fascinating point about how purpose and profit intersect. It's a critical differentiator for Laureate. Their status as a public benefit corporation under Delaware law is a crucial and unique aspect of its governance. What it fundamentally means is that the company's directors are legally mandated to manage the business in a way that explicitly balances the financial interest of stockholders with the best interests of other key stakeholders, think students, faculty, the local communities they serve.
Okay.
And critically, the company's specific public benefit purpose, which is essentially to provide quality, accessible higher education.
So it's not simply about maximizing profit for shareholders at all costs, then. It's a more complex balancing act written into their charter.
Precisely. It's legally mandated. And this dual consideration presents a fascinating dynamic for investors. On the positive side, this PBC status formalizes Laureate's commitment to academic quality and positive social impact. This can significantly enhance its brand reputation, strengthen relationships with regulators, which is particularly important in education, and align the company with the long-term interests of the communities it serves, potentially mitigating certain social and regulatory risks.
Okay, that makes sense. The potential upside.
Right. However, on the other hand, there's a theoretical potential conflict. Decisions could, in theory, prioritize the social benefit over maximizing short-term shareholder returns. But it's truly worth noting, and this addresses your point about tension, that the company's recent aggressive share repurchases and focus on financial metrics suggest a very strong alignment with shareholder value right now. So it makes this PBC status more a point for ongoing monitoring rather than an immediate red flag. It's kind of a compelling experiment in capitalism with a conscience, you might say.
Yeah, balancing profit and purpose. So how are management's motivations and incentives aligned with shareholder interests, especially given this PBC status? What does their compensation structure tell us?
Well, management's motivations appear to be very well aligned with shareholder interests, despite the PBC status perhaps adding complexity. There's a clear and consistent focus on driving operational efficiency, fostering organic growth, and proactively returning capital. Their executive compensation structure really reinforces this.
How so?
It's heavily tied to performance, with significant stock and options awards. For example, CEO Eilif Sirk-Hansen's 2024 compensation was an impressive 82.3% in bonuses, stock, and options.
Mostly performance-based, then.
Very much so, directly tying his personal wealth to the company's long-term performance. Furthermore, he directly owns 0.5% of the company's shares, a stake worth approximately $21.6 million.
Significant skin in the game.
Exactly. This substantial personal investment further aligns his interests with long-term value creation for all shareholders. So, while the PBC status introduces that theoretical balancing act, management's personal incentives are very much tied to financial performance, creating a powerful convergence of purpose and profit, at least in practice so far.
Okay, we've laid out the transformation, the operational core, the market opportunities, and the impressive financial turnaround. But as with any investment, especially in emerging markets, no picture is complete without a clear understanding of the risks. What are the key risks that someone looking at Laureate needs to understand and continually monitor?
Yeah, you're right. The risks are crucial here. And without a doubt, the most significant and pervasive risk cluster for Laureate is foreign exchange and geopolitical risks.
FX and geopolitics, top of the list.
Absolutely. With all its revenue generated in Mexico and Peru, its U.S. dollar-reported financial results are incredibly sensitive to the daily volatility of the Mexican peso and the Peruvian sol. We saw this evident in their financial guidance, right? The initial 2025 outlook cited a weaker Mexican peso as a headwind, only for more favorable exchange rates later in the year to actually prompt an upward revision to their guidance.
Right, it cuts both ways.
Exactly. It's a constant, unpredictable factor that can swing reported results significantly, regardless of underlying operational performance.
So those currency fluctuations can really swing the numbers dramatically, making it harder to predict. What else falls under that broad umbrella of geopolitical risk?
Well, beyond the immediate impact of currency, the company is just inherently exposed to the broader political and economic stability of these two emerging markets. Any significant political turmoil, for instance, an unexpected shift in government, adverse changes in government policy towards foreign investment, or severe prolonged economic downturns in Mexico or Peru could all materially and adversely affect Laureate's operations.
Yeah.
It could impact student enrollment trends, and ultimately undermine its overall financial performance. While they've proven resilient through some volatility, it's an ever-present backdrop you have to consider.
And what about regulatory and compliance risks? Education, especially private education, is a sector that's notoriously heavily regulated, isn't it? You mentioned SUNADU in Peru.
That's an excellent point, and yes, it's heavily regulated. Higher education is indeed heavily regulated in both countries, but particularly by SUNADU in Peru, which we discussed earlier as having actively reshaped the market. The risk of adverse regulatory changes is constant and can take many forms. Stricter accreditation standards, new rules specifically targeting for-profit institutions, modifications to student financing programs, or even mandates on curriculum content.
Lots of potential changes.
Lots. And complying with these evolving regulations can be costly, time-consuming, and require significant resources. Any failure to do so could result in severe sanctions, the devastating loss of accreditation, or even limitations on their ability to grow or offer certain programs. That would be extremely damaging to both their brand and their bottom line.
And what about competition? We touched on it earlier, but how intense is it really? Are they truly battling on multiple fronts?
Oh, absolutely. Laureate operates in a truly intense competitive environment, battling on two distinct fronts that create constant pressure. First, they face competition from public universities in both Mexico and Peru. As we said, these institutions are often prestigious, deeply embedded in national culture, and crucially, either free or heavily subsidized.
The price ceiling again.
That permanent, structural price ceiling. It forces private providers like Laureate to continuously justify their tuition fees through a clearly superior value proposition, whether that's modern facilities, specialized programs, flexible delivery, or demonstrable career outcomes. Second, there's intense competition from other private institutions. The private sector in both countries is quite fragmented, with numerous other providers vying for students. To maintain its market share and pricing power, Laureate must continuously differentiate its offerings based on academic quality, modern facilities, flexible delivery models like their hybrid and online options, and, perhaps most importantly, demonstrable graduate employability outcomes that prove the return on a student's investment. It's a constant fight for market relevance and share.
Given that private education is often a discretionary expense for many families, economic conditions must also pose a significant challenge. How sensitive are they to economic cycles?
Yes, demand for private higher education is inherently cyclical and highly sensitive to the economic health of its target markets. A recession, an unexpected economic downturn, or a prolonged period of high inflation in Mexico or Peru could significantly reduce household disposable income.
Making tuition harder to afford.
Exactly. This would make private university tuition less affordable for many families, potentially leading to lower than expected new student enrollment, higher student dropout rates, increased demand for financial aid, and greater pressure on tuition pricing. All of these factors would inevitably translate into negative impacts on Laureate's financial results. They are definitely not immune to the broader economic winds.
And what about the very foundation of an educational institution? Accreditation and quality assurance, that must be absolutely non-negotiable, right?
You're absolutely right. Maintaining institutional and programmatic accreditation is utterly fundamental to the viability and credibility of any higher education provider, especially one operating in regulated markets like these. Accreditation serves as the primary, most visible indicator of academic quality and is often a prerequisite for students to receive government-sponsored financial aid or even for their degrees to be recognized for professional licensing.
So losing it would be catastrophic.
Catastrophic. Any loss of accreditation for one of Laureate's key institutions would be severely damaging to its brand reputation, its ability to attract and retain students, and critically, its overall financial stability. It is, simply put, a non-negotiable foundation of their entire business.
Finally, let's consider the most extreme scenario, maybe the tail risk. What's the risk of a catastrophic loss here? Is there a plausible scenario where this investment could go completely south?
Yeah, it's worth thinking about the extremes. A truly catastrophic loss for Laureate would likely require a severe, simultaneous, and systemic political or economic event impacting both Mexico and Peru at the same time.
Both at once.
Okay. Yeah, we're talking about scenarios like widespread asset expropriation by governments or maybe a sudden dramatic regulatory change that makes for-profit education illegal entirely across both countries. While Peru, as we know, has experienced significant political instability in its recent past, and Mexico faces ongoing security and governance challenges, the complete simultaneous loss of operations in both countries at the same time, that feels like a low probability, albeit high impact tail risk.
Low probability, high impact.
Exactly. While the company's strong balance sheet with its net cash position provides a substantial buffer against typical operational downturns, it would naturally not protect against such extreme systemic geopolitical events. It's a risk to acknowledge, for sure, but it sits at the very far end of the probability spectrum, in my view.
Okay, so we've got this thoroughly transformed company. Strong financials, dominant market positions, but also some very clear and concentrated risk, primarily geographic. The market, in its wisdom or lack thereof, prices all of this in. How does Laureate Education currently stack up in terms of valuation? Is there a noticeable valuation gap compared to its publicly traded peers, maybe those based in the U.S.?
There appears to be a quite noticeable and persistent valuation gap, yes. A relative valuation analysis indicates that Laureate Education currently trades at a discount when compared to several of its U.S.-based peers in the education services industry.
Okay, who are we comparing them to?
We're talking about companies like Adtalem Global Education, ATGE, Grand Canyon Education, LOPE, and Prodosio Education, PRDO, all of whom operate in broadly similar, though certainly not identical, sectors.
Right, similar but different geography. Can you give us some specific metrics to illustrate that discount? What are we looking at numbers-wise?
Absolutely. Let's look at some key metrics using trailing 12-month data, say as of early September 2025, just for illustration. Laureate's GAAP price to earnings, or PE, ratio is around 16.6x.
Okay, 16.6.
Now, compare that to Adtalem Global Education, which is trading at about 22.2x, and Grand Canyon Education at a robust 24.7x.
Quite a bit higher.
Yeah. And the difference is arguably even more stark on an enterprise value to EBITDA or EBITDA basis. Laureate is at 10.0x, while Adtalem is at 13.6x, and Grand Canyon is way up at 16.5x. What's truly insightful here is that this discount isn't just a historical anomaly. It persists even when you look at forward-looking valuation multiples. It suggests the market kind of expects this gap to continue.
So why does this discount exist? Is it just market irrationality, or is there a clear, discernible reason the market is applying this lower valuation? What's the story behind the numbers?
This brings us to a crucial point, and perhaps the central insight for you, the learner. This discount isn't just some simple risk premium. It presents a fascinating potential arbitrage opportunity for those willing to look deeper, maybe. The market is clearly pricing in Laureate's concentrated exposure to Latin American geopolitical and foreign currency risks.
Ah, the LATAM risk factor.
Exactly. U.S.-based peers, by contrast, don't have that same direct, concentrated exposure to the volatility of currency fluctuations or the political stability questions of emerging markets. The market is essentially applying a risk premium, a discount, to Laureate's earnings and cash flows, precisely because of where it operates.
Okay.
However, the true insight here perhaps is recognizing that their risk is also their edge in some ways. The very demographic tailwinds and growth prospects that come with these regions are arguably far superior to those in more mature developed markets like the U.S.
So higher growth potential, but higher perceived risk.
Precisely. The market might be underestimating Laureate's proven capability to not just survive, but actually thrive in these dynamic environments, leveraging its on-the-ground expertise, its strong brands, and its efficient operating model. They've navigated some rough seas already.
So for you, the learner listening right now, this poses a really interesting investment question, doesn't it? It's not just about the numbers on the page.
Exactly. The central question for you as an informed learner, or maybe a potential investor, truly boils down to this. Is this discount overly punitive? Given Laureate's proven market leadership, its robust organic growth profile, its now pristine balance sheet, and its aggressive capital return program, are the superior growth prospects inherent in these emerging markets enough to compensate for the inherent volatility and risks associated with operating there? It's that classic balance of potential reward against identifiable risk, and where you draw that line determines whether this looks like a fair valuation or maybe a compelling opportunity. #tag8. Key takeaways and listener reflection.
This has been a really deep dive into an extraordinary transformation. Let's try and distill this complex story into our key takeaways for you. First, what are the primary drivers behind Laureate's earnings now? Where's the money coming from, essentially?
Right. Laureate's earnings are currently at what looks like a cyclical high post-transformation. They're driven by a crucial, almost symbiotic combination of internal actions, things like meticulous management of student enrollment, strategic tuition pricing, and disciplined cost control across their operations.
Things they control.
Exactly. And external factors, predominantly the fluctuating foreign exchange rates we keep mentioning, and the broader political and economic stability of Mexico and Peru. It's a constant dance between what they control internally and what the external market environment provides.
And what about the business model itself? How clear and focused is it now compared to its sprawling past? It seems much simpler.
What's genuinely striking here is the clarity and simplicity of the new business model. It's a straightforward, yet highly effective business operating private universities exclusively in Mexico and Peru. Revenue comes almost entirely from student tuition and fees. The company is laser-focused on organic growth, continually supported by its now exceptionally strong balance sheet. And critically, the brands they operate, UVM, Unitech, UPC, UPN, are absolutely vital. This is not a commodity business where price is the only differentiator. Brand equity, trust, and reputation are paramount.
And that strong cash flow we discuss, how is that robust cash generation being put to use? What's the philosophy there? Seems pretty clear.
Yeah, Laureate is a highly cash-generative business, almost like a cash machine now. Their capital allocation philosophy is very clear, transparent, and frankly, shareholder-friendly. It's that two-pronged approach. Intelligently reinvest in organic growth, particularly through new campus expansion, to meet demand.
Investing back in the business?
Right. And return excess capital to shareholders through aggressive share repurchases and carefully considered special dividends when appropriate. It's a pretty balanced approach to capital deployment.
What about the barriers to entry in this industry? Is it easy for new competitors to pop up and challenge Laureate's dominance in Mexico and Peru?
Well, the industry, while profitable, is intensely competitive, as we've said. But critically, there are significant and often underappreciated barriers to entry. These include the massive capital requirements needed to build and operate quality campuses, the arduous, time-consuming process of establishing a strong, reputable brand to attract students in a competitive landscape.
Takes years, decades even.
Exactly. And the complex, ever-evolving regulatory and accreditation hurdles in each country, especially with bodies like UNEDU. These aren't simple businesses to start or scale, especially not with the quality and breadth Laureate offers.
So what's the overall outlook for Laureate going forward, given all these factors we've discussed?
Positive, cautious. I'd say the outlook is decidedly positive, albeit with those caveats about external risks. Both Mexico and Peru's higher education markets are projected for strong, sustained growth, driven by those powerful demographics and the deep-seated aspiration for upward mobility. Laureate is actively expanding its capacity to meet this demand, with new campuses continually underway. That positions them well to capture a significant share of this expanding market.
And once a student is in the system, how easy is it for them to leave and go to another institution? Is there a level of customer stickiness in this business that seems important for predictability?
That's a crucial and often overlooked aspect of the education business model. Once a student is enrolled, particularly past the first year or so, the switching costs are remarkably high.
High switching costs. Okay.
Yeah. Changing universities involves potential loss of time, loss of credits, additional administrative hurdles, disruption of social networks, and often a financial penalty. This creates a very sticky customer base for Laureate's institutions. It means that once they've captured a student, the probability of retaining them through to graduation is quite high, which provides stable and predictable revenue streams over several years. Hashtag outro.
And that brings us to the close of our deep dive into Laureate Education, Inc. We've explored a truly remarkable journey, haven't we? From a sprawling global conglomerate, once weighed down by debt and complexity, to a focused, financially robust leader in two critical, high-growth Latin American education markets. It's really a testament to bold strategic decision-making and disciplined execution.
It really is. We've highlighted its key strengths, including its formidable market leadership in Mexico and Peru, its sophisticated hybrid education model that smartly embraces digital learning, its now pristine balance sheet that net cash position is huge, and its clear, aggressive commitment to shareholder returns through buybacks and potential special dividends.
But we've also gently, yet firmly, underscored the concentrated risks, right? The ever-present foreign exchange fluctuations, the dynamic realities of geopolitical instability, and the constant scrutiny of regulatory bodies in these vibrant but sometimes volatile regions. You can't ignore those.
Absolutely not. They are part of the investment thesis.
So this leaves us with a truly thought-provoking question for you, the listener, to carry forward, something to mull over. Laureate uniquely operates as a public benefit corporation, legally mandated to balance financial returns with its social impact, driving social mobility for many first-generation university students. We talk about that 47% number.
A powerful mission.
Yet we've seen its aggressive share repurchase program alongside this very unique mission. Given this dynamic interplay, what do you think this means for how Laureate will continue to balance profit and purpose in the evolving landscape of Latin America? How might its continued growth further its public benefit mission, and what implications does that have for its long-term value and its lasting impact on society? That's a fascinating thought to carry with you as you continue your own deep dive.